Santos was priced like a company with a major project almost ready, and that distinction mattered more than most holders realized. When a stock carries a large capital project in pre-production, institutional positioning reflects optionality. The asset's future cash flows are discounted by execution risk, timeline uncertainty, and the unresolved question of whether the wells will actually perform. On May 18th, that execution discount disappeared. Oil flow through the lease automated custody transfer meter into the Pikka sales line is not a press release milestone. It is the moment the market's required risk premium on that asset compresses. 28 development wells had already been drilled by First Oil. 21 had been stimulated and flowed back as anticipated, which means the reservoir is behaving within the model Santos used to justify the investment. That confirmatory data point is what forces a repricing, not the announcement itself. The prior Santos thesis held that Pikka was the company's most important long-duration growth option in a portfolio that was otherwise weighted toward maturing LNG fields in Australia and Papua New Guinea. That framing assigned Pikka a role in the 5-year-out production curve and positioned holders as carrying a call on future barrels rather than current ones. First Oil converts that call into a forward delivery contract, first sales revenue arriving within 2 to 3 months, Santos and Repsol alternating tanker loads from Valdez. The thesis shift is not directional, it is structural. The type of capital that should want to own this stock changes when the asset class changes from development stage to producing. Growth fund positioning that tolerated execution risk now sits alongside yield-oriented energy mandates that require demonstrated production. That overlap is what drove the 2.5% single-session move on May 18th, even as the broader ASX 200 was down 1.2% on bond panic selling. But the ramp target, 20,000 barrels per day for roughly 1 month during commissioning, then an acceleration toward an 80,000 barrel per day plateau in the third quarter, means the full production thesis is not yet confirmed. The plateau is what actually closes the valuation gap between Santos and a comparably sized producer with no ramp uncertainty. Until water injection commences after the seawater treatment plant starts up, production will remain intermittent. Intermittent production means Santos carries a commissioning phase discount that will only fully collapse when plateau output is sustained, and that timing, the third quarter, is the next verification date the market will price toward. The 31% year-to-date move in Santos cannot be explained by Pikka alone, and that asymmetry is where the real positioning question sits. Brent crude had broken above $110 per barrel by mid-May, a level driven not by demand growth, but by the Hormuz double blockade that effectively severed 1/5 of global oil and LNG supply from world markets. The conflict began February 28th, when the US and Israel struck Iran. Tehran closed the strait in retaliation, and by early April, a fragile ceasefire existed on one front, while the maritime choke point remained strangled. For Santos, this created an external revenue multiplier that no internal operational decision could have generated. Higher spot oil prices lift realized revenue on every barrel Santos sells, including the production it was already generating from its existing portfolio before Pikka produced a single barrel. The geopolitical premium did not merely support the stock, it was the primary driver of the year-to-date move, with Pikka adding confirmation of future volume growth on top of an already elevated price score. As a countersignal to the simple bull case, consider the participant timing. Institutional energy mandates moved into Santos and Pier Woodside in the weeks after Hormuz closed, when the supply shock was most acute, and when most retail participation had not yet confirmed the move. The evidence for this sequencing sits in the relative performance divergence, Santos plus 31% year-to-date, while the ASX 200 gained only 4% over the same period, a gap that implies concentrated positioning by sector-rotating capital ahead of broader market recognition. Retail entry, by contrast, appears to have accelerated around the Pikka announcement, when the story became concrete enough to explain in a headline. That ordering gap matters because it means the investor base now contains at least 2 layers with different cost bases and different holding carried assumptions. The institutional layer bought the Hormuz premium early and holds a substantial unrealized gain. The retail layer entered closer to the peak and is more exposed to the scenario the market placed in on May 25th. What the Hormuz premium actually embedded in Santos's price was not merely a higher oil spot price, it was the market's assumption that the supply disruption would persist long enough for Santos's forward production curve, including Pikka's ramp, to be monetized at elevated realized prices. That embedded assumption is now the variable under pressure.
On May 25th, Brent crude fell more than 5% to $98 per barrel, and the mechanism behind that move is the same mechanism that built Santos's entire year-to-date return. Trump signaled over the weekend that a memorandum of understanding with Iran had been largely negotiated, covering a 60-day ceasefire extension, Hormuz reopening, and a framework for nuclear negotiations. The market did not wait for a signed agreement. It began deflating the geopolitical risk premium immediately because that premium was priced in on worst-case assumptions, and even a credible partial resolution compresses it fast. As Horace Kershane of Khabarhub Capital observed, a lot of oil was trading on worst-case assumptions for weeks. Once it became clear talks were still alive and escalation wasn't accelerating, a chunk of that fear premium comes out pretty fast. For Santos, this is not a parallel story to the Pikka milestone. It is a direct challenge to the same capital that owns the stock. The energy overweight positioning that accumulated during Hormuz disruption was rational at $110 Brent. Its continuation at $98 Brent requires a different justification, and that justification has to come from Santos's own production fundamentals rather than from the geopolitical environment. Pikka at 20,000 barrels per day during commissioning does not yet deliver that alternative justification at scale, but a sustained 80,000 barrel per day plateau, targeted for the third quarter, would add a volume increment large enough to offset a partial oil price retreat. The critical threshold is whether Santos's incremental Pikka production revenue, once plateau is reached at the 51% operating interest share, can sustain the earnings trajectory that the $8+ share price implies, at a Brent level meaningfully below $110. That calculation has not yet been tested, because the peace deal is not signed, and the Hormuz blockade formally remains in place until, as Trump stated, an agreement is reached, certified, and signed. Iranian officials have simultaneously asserted their legal right to manage the strait, and a senior IRGC advisor was quoted saying, "Our fighters have their hands on the trigger today," which is not the language of a counterparty ready to unconditionally reopen a strategic choke point. Gas Buddy analyst Patrick DeHaan captured the operational delay embedded in the scenario. Prices will only plummet when ships actually transit the strait, not when a deal is announced. The same logic applies in reverse to Santos. The geopolitical premium will not fully exit until tanker traffic normalizes, damaged Gulf facilities are repaired, a process analyst estimate at months, and the market stops pricing a disruption risk that physically persists. The monitoring variable is not whether a deal is signed, but whether the Hormuz premium compression in oil prices exceeds the earnings contribution from Pikka's volume ramp before the third quarter plateau is confirmed. If oil settles in the high 90s while Pikka is still in intermittent commissioning mode, the price of Santos reflects a future production rate that has not yet arrived, and that gap is precisely where the stock's next positioning test will occur. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.